Okay, welcome to the latest edition of Stuff Happens. Today we're talking about the passive allocations to the S&P 500 and what investors are really getting. In this slide that we're showing right here, shows the breakdown of AI and AI related companies as a percent, their makeup and their breakdown in the S&P 500. As you can see, it's almost up to 49% of again of the AI and AI related companies. So when investors are making an investment or an allocation to the S&P 500, what ostensibly what they thought is a passive index, and which is designed to give them a broad allocation and avoid making concentrated bets. They're actually absolutely making a concentrated bet, and that bet is on AI. And what we've been advocating and telling investors that they should be looking to do is to more broadly diversify. And one particular way that we suggest investors to diversify is in commodities. And commodities have single best diversifying the single best diversifying asset class. We spoke about that in the first webinar, and I ran a correlation this morning, and the BCOM index correlated against the top 25 tech names over the last 15 years. That correlation is essentially zero. So again, as a broad diversifying asset class, commodities, bar none, is the single best way to diversify against an index, which is clearly making a single bet. Darren, what's your thoughts on that?
I completely agree, and just taking it a bit further, I mean the top 10 stocks within the S&P make up about 40% of the index weighting as well. So, I mean, they may not be all classified as strict AI, but they're certainly tech names. So, and by the way, AI runs on energy and materials. So whether that's infrastructure, materials being infrastructure and metals. And those two combined, energy and materials, make up only about 6% of the S&P 500. So certainly you need one to run the other. We cover the other, which is again that 6%, and we think that over the next few years will at least double in terms of its allocation in the S&P. But it's not just diversification that we're advocating with commodities and real assets. It's also, from a valuation perspective, as I just stated, it's much cheaper. Also, an inflation hedge. We've seen the CPI, PPI numbers come out. They're not great. And what we think is occurring is essentially a cycle rotation into these names. So I think on almost every level, it makes a lot of sense to bump up your allocation to commodities and real assets.
Right, and I think it's important to note too that we're not making any kind of generalization or opining on whether this technology is life changing or we're basically what we're just saying is that because of what's happened with the market and the rotation of the market into these AI names, that passive bet that investors think they're making is essentially a very concentrated bet. And I think Darren brings up a good point. I think that not only can you gain excellent diversification and moving into the names that we're talking about, into the resources and the natural resources and the sectors we're talking about. It's actually thematically, we've talked about this, kind of ad nauseum in some of the other webinars. There's some definite reasons why you want to be allocating to resources at this particular point in time, and then some of those are more secular shifts. Um, but again, thanks for joining us, and look forward to speaking to you next week.